In 2023, global debt hit an eye-popping $305 trillion, more than 3 times the size of the entire world economy. Let that sink in. The so-called wealth we see around us is often built on borrowed money, creating an illusion of growth. But who's really benefiting from all this? The top 1% own 39% of the wealth, while wages for the rest of us have barely moved in decades. It might feel like we're all part of a system that's working, but what if I told you the global economy is more like a pyramid scheme than a model of prosperity? In this video, we're going to break down how debt, speculation, and market manipulation are keeping the rich in control, while the rest of us are left to play catch-up. I'll show you how value investing is the antidote to this cycle, and why it could be your ticket to building real wealth, without being trapped in the game. Stick with me, and let's uncover the truth behind the economy's big secrets. Chapter 1. The Illusion of Wealth. How the pyramid scheme fits in today's world. It often feels like the economy is built on a solid foundation of growth and prosperity. But what if I told you that this so-called wealth is often an illusion? A pyramid scheme of sorts that benefits a select few. Here's the twist. Modern economies, especially in the West, are often run on borrowed money. This creates an illusion of endless growth, while the reality is much darker. Consider this. Since 2008, global debt has exploded. As of 2023, global debt stood at a staggering $305 trillion, which is over 3 times the size of the entire global economy. That's more debt than we've ever had in history. The question is, who benefits? It's the top-tier financial institutions and corporations that thrive while the average person gets stuck with rising living costs and wage stagnation. This is where value investing enters the picture. Unlike speculating on rising stock prices driven by this debt cycle, value investing focuses on the fundamentals. The strategy isn't about following the crowd or buying into inflated stocks. It's about finding companies that are undervalued and have long-term growth potential. These are businesses that generate real value, those with solid earnings, strong balance sheets, and cash flow. For example, Warren Buffett, one of the greatest investors of all time, said, "Price is what you pay. Value is what you get." This simple yet powerful statement emphasizes that focusing on real value rather than market noise is the key to building wealth. While others chase fleeting trends, value investors keep their eyes on the underlying strength of a business. So, how can you implement this? Start by learning how to assess the intrinsic value of a business. Look beyond the stock price and analyze financial statements. A company with consistent earnings, low debt, and a competitive advantage will often be undervalued in a market driven by hype. By shifting your focus to value, you're not just playing along in a pyramid scheme. You're creating real wealth based on sound financial principles. And that's a game changer. Chapter 2. The Trickle-Down Myth. Where does your money actually go? You've probably heard of trickle-down economics, the theory that wealth generated at the top will eventually flow down to the rest of us. But if that's true, why are the rich getting richer while the middle class shrinks? This myth has been debunked over and over again, but it still seems to influence economic policy. The reality is, wealth doesn't trickle down. It trickles up. Since the 1980s, the top 1% of earners in the US have seen their share of national income double, while wages for the average worker have remained stagnant. According to the Economic Policy Institute, the top 1% now own 39% of the country's wealth, up from just 27% in 1989. Meanwhile, the bottom 50% of the population owns just 2%. This doesn't just happen by accident, it's by design. The current financial system, with its reliance on debt and speculation, funnels wealth to the top. For example, large corporations benefit from low interest rates, which they use to borrow cheaply and increase stock buybacks. This inflates their stock prices, benefiting shareholders who are often in the top 1%. Meanwhile, wages and job security for regular workers take a backseat. Enter value investing. While the economy may be structured to benefit the few, value investors focus on companies that are undervalued due to market inefficiencies. They invest in businesses that are not just profitable but have a long-term sustainable model that will continue to grow regardless of the overall market conditions. These are businesses with real value, not just speculative assets. The strategy here is simple. Invest in companies that are overlooked by the broader market but have strong fundamentals. This way, you're not at the mercy of trickle-down policies. You're building wealth on your terms by focusing on solid businesses that can withstand economic downturns. It's like Buffett's famous advice: the stock market is a device for transferring money from the impatient to the patient. Value investors understand that wealth is built through patience and discipline, not by chasing trends. Instead of relying on policies that promise growth for everyone, value investors focus on finding long-term winners. Chapter 3. The Debt Trap. How central banks prop up the pyramid. If you've ever wondered why we keep getting deeper into debt, it's because the global economy is designed to rely on it. Central banks like the Federal Reserve play a crucial role in this process. By lowering interest rates and printing more money, they essentially inflate asset prices, creating the illusion of economic prosperity. For instance, after the 2008 financial crisis, the Federal Reserve pumped over $4 trillion into the economy. This wasn't free money, it was borrowed, and it inflated stock prices, bond prices, and real estate values. This debt-driven economy has only continued to grow, with central banks now holding trillions in assets. But who actually benefits from all this? It's the wealthy investors and corporations who have access to cheap credit, allowing them to acquire more assets while the rest of the population faces higher costs. But here's the kicker: while central banks keep rates low and increase the money supply, they're also creating a dangerous bubble. When interest rates eventually rise or the debt becomes unsustainable, this bubble could burst, sending shockwaves through the financial system. And when it does, it's the average person who will bear the brunt. Now, how does value investing fit into all this? The answer lies in the fundamentals. While the global economy is built on debt and speculation, value investors focus on companies with real, tangible assets. These are businesses that can survive a downturn, maintain profitability, and generate consistent cash flow. They don't rely on debt-fueled growth to succeed. A great example of this strategy comes from Ben Graham, the father of value investing. He once said, "The investor's chief problem, and even his worst enemy, is likely to be himself." The key here is to avoid getting swept up in the frenzy of speculative bubbles and focus on businesses that can weather the storm. By investing in companies with strong balance sheets and low levels of debt, you're essentially protecting yourself from the very debt trap that the global economy is built on. The goal is to invest in companies that don't need constant borrowing to stay afloat, which gives you peace of mind during times of uncertainty. In the end, the debt-driven economy might be a pyramid scheme, but by sticking to value investing principles, you can create wealth based on solid fundamentals, not on borrowed money. That's how you escape the trap. Chapter 4. Ponzi schemes of the stock market. The dark side of growth. When you hear the term Ponzi scheme, you probably think of fraudsters like Bernie Madoff. But did you know that parts of the stock market have a similar dynamic? The reality is, much of the so-called growth in stock prices is driven by speculative buying, not real improvements in company fundamentals. This is the dark side of growth investing. A Ponzi scheme thrives because early investors are paid with money from new investors, not from profits generated by the business. Similarly, in the stock market, prices are often pushed up by momentum and speculation rather than underlying earnings growth. For example, in 2020, the tech sector saw a massive surge, largely driven by speculation around companies like Tesla and Amazon. Many investors were betting that these companies would continue to skyrocket without considering whether their valuations made sense in the long term. The result? A bubble. By mid-2021, Tesla's price-to-earnings (P/E) ratio was over 1,000, compared to a historical average of 15-20 for most stocks. Such sky-high valuations are a red flag. They suggest that the market is pricing in future growth without any real basis in current profitability. This kind of speculation can't go on forever. But here's where value investing provides a solution. Value investors don't chase hype. They look for companies that are undervalued based on their fundamentals. They focus on earnings, cash flow, and assets. For example, Buffett's approach has always been to look for companies trading for less than their intrinsic value. He's known for buying undervalued stocks with a margin of safety. Instead of getting caught up in the euphoria of growth, value investors are patient and disciplined. They focus on what's real, solid earnings, a proven track record, and sustainable growth. When the bubble bursts, value investors are less likely to be caught in the aftermath, as their investments are grounded in reality, not hype. Chapter 5. The Greater Fool Theory. Are you the next fool? The Greater Fool Theory is one of the riskiest ways to approach investing. The idea is simple. Buy an overvalued asset with the hope that someone else will pay even more for it. It's a dangerous game, and eventually, you're left holding the bag when there are no greater fools left to buy. And yet, this theory often drives much of the market behavior we see today. Take the example of cryptocurrency during its boom years. In 2017, Bitcoin's price skyrocketed from around $1,000 to nearly $20,000 in just 1 year. Many people jumped on the bandwagon, hoping they could sell to someone else for a higher price. But when the market collapsed in early 2018, they were left with massive losses. Those who didn't understand the fundamentals of the market were trapped in the cycle of the greater fool. Here's the real kicker. The greater fool theory is still alive and well. In 2021, meme stocks like GameStop and AMC saw wild swings in prices due to hype-driven buying. Investors poured money into these stocks with no regard for the fundamentals, hoping they could sell to someone else who would pay a higher price. The result? A massive amount of volatility and instability. This is where value investing shines. While others are chasing the greater fool, value investors focus on intrinsic value. They look for companies with real earnings, strong balance sheets, and a history of profitability. When others are caught up in speculation, value investors are quietly building a portfolio of solid, undervalued companies. Warren Buffett is a firm believer in the importance of intrinsic value. He once said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This means that value investors don't gamble on the whims of the market. They invest in companies that are undervalued based on their true worth. So, how do you avoid becoming the next fool? The key is to focus on the long term. Invest in businesses that have a proven track record of generating value. Don't chase trends, and don't fall for the hype. Instead, focus on the fundamentals that will continue to drive success over time. Chapter 6. Building Your Own Pyramid. Value investing as the anti-scheme. If you've been paying attention, you've probably realized that the global economy has a pyramid scheme vibe. It's built on debt, speculation, and short-term gains, which benefit the wealthy few. But what if you could build your own pyramid? A pyramid built on real value and long-term growth. That's exactly what value investing allows you to do. Unlike the debt-fueled pyramid of the global economy, value investing focuses on creating wealth through ownership of high-quality assets. This is the foundation of your own pyramid. Instead of relying on market speculation and hype, you focus on undervalued companies with strong fundamentals. These are businesses that will continue to grow and generate returns, regardless of the economic landscape. One of the key principles of value investing is patience. It's not about quick wins or jumping on the latest trend. It's about understanding that wealth is built over time. The companies you invest in should have staying power, businesses that can endure economic downturns, adapt to changing markets, and continue to generate value for their shareholders. Let's talk numbers. According to data from Credit Suisse, the average annual return for U.S. stocks has been around 9.6% over the last century. However, this figure can be distorted by short-term volatility. The real returns come when you hold on to high-quality companies through thick and thin, focusing on the fundamentals rather than the fluctuations of the market. This is why value investors like Buffett have been so successful. He's built his wealth by focusing on companies with a sustainable competitive advantage, companies that are undervalued and offer solid growth prospects. His strategy isn't flashy, but it works. Buffett has famously said, "Our favorite holding period is forever." The point here is that while the global economy might be a pyramid scheme, value investing offers a way out. By focusing on businesses that are undervalued and have strong fundamentals, you can build your own pyramid of wealth. It's a strategy that's grounded in reality, not speculation. So, how do you start? Begin by learning to evaluate companies based on their intrinsic value. Look for businesses with low debt, strong cash flow, and consistent earnings. Don't get swayed by short-term market noise. By focusing on these principles, you can build a portfolio of assets that will continue to grow, even when the broader economy falters. Thanks for watching. If you found this video valuable, don't forget to subscribe for more insights on smart investing strategies that can help you build real wealth.